As I learn, the Incred Healthcare PMS portfolio top line grew at a much more impressive clip than the bottom line did. Now, you could argue multiple reasons could have been there. The least non-obvious reason is the fact that costs for all companies across the world have been high, and that would have hit the companies in the portfolio as well. The fund manager now believes that there is a potential for the profit growth to return to normal, albeit outstrip the top line growth. The question, therefore, that arises is that at a point of time when sector ROE and price to book multiples are at the lower rates or the lowest in some time, is it a good time to try and invest in the healthcare space? That is, in fact, one of the principal talking points with Incred's Aditya Khemka today. We'll also talk to him about whether the API CDMO space has some structural problems or are these cyclical issues? We'll talk to him about the legitimacy of his contrarian view on diagnostic stocks. We talk to him about hospitals and whether we are closer to peak margins and ROE or is still the runway for improvement. Lastly, talk about the top bets in the healthcare sector. He joins in right now to talk about all of this. Aditya, great having you as always. Thanks for being here.
Thanks, Neeraj. Great being here.
Thank you. Aditya, I'll start off with a simple question. Why is it that you believe that there is a probability of uh, profit growth numbers starting to look better as FY24 rolls on? Is it just the cost pressures abating, or is there something else?
No, so there are two, three elements to our thesis that the future PAT growth will be faster than the top line growth. If you look at from FY21 to 23, and I'm talking at our portfolio holding level because the sector is just too wide and too large, so I can't give you a sector number, but I can give you my fund number. So at my fund number from FY21 to 23 over the past 2 years, the top line growth that the fund holding companies have seen at an aggregate level is about 11%. But the PAT growth or the profit after tax growth has been only about 3% CAGR. Now, the reason why the PAT growth has been significantly lower than the top line growth, there have been three reasons. The first reason is obviously raw material pressure. So, majority of these pharma companies, as we discussed earlier, import raw material or key starting material from China. And when you import that, and Chinese prices are up for various variety of reasons, not restricted to the COVID shutdowns, the traders holding, and several other factors. So, because those raw material costs were high, the top line grew, but the PAT did not grow in line with the top line. The second element was obviously the logistic cost. So, pharma being a good that is exported and transported across the globe from India, because logistic cost containers were not available, an average container price which used to be $1,000 a container has had shot up to $5,000-6,000 a container, on the shipping lines. So that has impacted, cost below the gross margin. And then the third most important factor was the ability to pass on the cost to the customer. Now, in many businesses, there were some price increases taken. For instance, hospitals took price increase, some diagnostic companies took price increase, even some branded generic companies took price increase in India. But these price increases were just not enough to cover for the cost escalation that they saw in the P&L, and that again resulted in sort of a increase in the cost element, as in decrease in the margin, and therefore the top line grew faster. Now, what has changed and what we believe is changing is that the material cost from China is coming down. So the China unlock story, right? So that is clearly going to remove the supply constraints, the bottlenecks that we have seen over the past 2 years. And that will help these pharma companies and healthcare companies to report better margins because their pricing has already gone up. So now when the raw material cost comes down, you are going to see a significant improvement in margins. In fact, the margins could be higher than the pre-COVID levels if the raw material prices reaches the pre-COVID level, because the pricing is already higher than the pre-COVID
Yeah,
level,
yeah, yeah.
and the pricing doesn't retrace. So once you have taken a price increase, it stays, especially in the branded generic space and the hospital and the diagnostic space. So if there is a price increase there, it sticks. But the raw material cost comes down to pre-COVID levels, then you see better margins than the pre-COVID margins. Although that is not what we are building in. We are actually building in our thesis slightly lower margins. So just to give you numbers here, Neeraj, if FY24, we see a 11 to 12% top line growth and a 30 to 35% PAT growth, three times the growth in top line. Then over the past 3 years, the CAGR of PAT and top line would have been same, which is about 11-12%. So if just the margins were to restore to the pre-COVID margins in the coming year, you will see a 30 to 35% PAT growth at a fund level, at an aggregate level in the fund. Now, what gives us the confidence that this will happen? The pharma companies, when we speak to them, they are already telling us that the spot raw material prices have significantly corrected. They're still not at the pre-COVID level, they're slightly above pre-COVID levels, but they have corrected significantly from the top. Now, why is that not reflecting, let's say, in the third quarter results? The reason for that was inventory. So,
Inventory.
in the past 6 to 9 months, China was under lockdown sometimes and opening sometimes and locking down again. So, these pharma companies essentially don't want a stock out situation, right? You work day and night to acquire customers. And the last thing you want is you go stock out and you lose those customers. So, the customer acquisition cost is a significant cost in healthcare, just like in any other industry. And there, if you want to do, if you get to lose those customers just because you didn't have enough raw material, that's sort of the worst case scenario that you can think of. And therefore, this stocked up. So even though the spot prices have come down in raw material, the third quarter earnings did not really reflect that in the margins. That will probably get reflected over the next 6 months.
Got it. So let's assume that this is the base case scenario, and if this, and let's assume this were to happen, Aditya. Therefore, is that the precursor for buying into a sector which is currently completely out of favor because there is a bad growth, and of course, because it's out of favor, the valuation, the starting multiples are certainly very attractive, but
Yeah.
you look at the CanSlim approach proponents, and they would say that stocks are low for a reason and stocks are high for a reason, and therefore don't go out fishing into a pond wherein it's out of favor completely. Do you
Correct.
believe this is the right time? And if so, why?
So, to my mind, any stock, any sector, see, there are various styles of investing. One style of investing is to sort of chase momentum, chase growth, where there is currently enough data to tell you that the sector is in momentum or the stock is in momentum for that matter. We don't follow that approach. Our approach is more contrarian in nature or more conservative in nature. We don't like to overpay for growth. So what we look at is we look at the longer term trends. So this is not the first time we have seen inflation in raw material, or we have seen an oil price hike, or we have seen a logistic price shock. These all have been seen in the past decade, at some point or the other. But the sector always comes back to the mean margin. In fact, goes above the mean margin sometimes, and the multiples also come back to the mean and then go above the mean sometimes. Now that happens because your demand for the sector is non-discretionary, right? And the consumer doesn't really care. If he has lesser money, he would probably not buy other goods which are discretionary goods or services. But healthcare goods and services he's just going to consume. He cannot avoid consuming that. So,
Yeah.
so therefore, what happens eventually is you have restoration of margins, you have restoration of growth, you have restoration of multiples. Now, what you can debate on is how long would it take to get there. So, it can take 6 months, it can take 12, it can take 24. But in our style of investing, timeline is probably not the most important criteria. The important criteria is preservation of capital and ensuring longer term wealth creation for our shareholders and unit holders, and which is where we like to invest when nobody's looking at the space. And today, I think that is the scenario with healthcare. If you look at past 10 years, I think this is one of the lowest weights healthcare has had in the broader indices within India. Outside India, healthcare sector and other indices have more than 10% weight. In India, the average weight is about 6-7% over a past 10-year period. And today we are at around 4%, which is closer to the trough, that we have seen over the past 10 years. So clearly there's a lot of pessimism, and there is a reason for the pessimism, right? The recent earnings have missed estimates. There have been earning downgrades, but there will be earning upgrades. See, Excel sheet is a wonderful thing. You see 2 years of margin depression, and that gets extrapolated for 20 years. And the same thing happened in COVID. No, you saw margin inflation, and that got extrapolated for
Yeah,
20
yeah.
years, and you saw stocks flaring up in healthcare. The opposite is true right now, right? So I think that's just the way markets behave, and that's something we can leverage on.
Okay. So, well, and viewers, keep in mind, I think the important part of this conversation or this answer was that for Aditya in particular, at least, and their style of investing, the timeline is not the most important factor. And therefore, he's not betting upon the gains accruing in the next one quarter itself. So, if your time horizon is accordingly so, then this may not be the most fruitful conversation for you. But if your time horizon is slightly longer, then yes, do stay tuned, because now I'll move on to the specifics of the healthcare sector, because as Aditya said, it's a very wide bucket. Um, Aditya, let's start off with the what everybody considers the base pharma companies, right? Which is either the US generics or the Indian generics. Now, for a while now, you've stayed not exactly in favor with the US generics, and you've liked the Indian generics. You've always told me that these are cyclical plays, and at some point of time, demand supply ensures that the cycle turns and they become investable. So, my question to you is one, the US generics, is the cycle turning? Why or why not? And then on the Indian side, are you constructive relative to the US generics or are you not?
So on the US side, I think we remain a little cautious. See, the past quarter earnings, especially the third quarter earnings, actually for the US generics were positively surprising to us. But the reasons, when we dug into the reasons of why they were positively surprising, the two reasons which stood out was number one, US went through a very, very severe flu season in the third quarter. And whenever flu seasons is very severe, there's a lot of co-prescription of other drugs that happen because along with flu drugs, you have to take other drugs to ensure that you get well sooner. So that created some demand, in the past quarter, which again, because flu is a seasonal disease, it's only a third quarter disease. It may not recur in the fourth quarter. And the second reason was this one large product which went generic, which was Revlimid. And a lot of Indian generic companies have Revlimid in their portfolio, and that sort of is giving them that incremental revenue. But Revlimid is maybe a 3-4 year cash flow. I think FY26 is when Revlimid completely goes off patent and it becomes a commoditized market. But till FY26, it can remain a slightly interesting product. But the point here is that these unbranded companies, they trade at 25, 30 times price to earning multiple, and Revlimid is a 3 to 4 year cash flow. For that cash flow to get 25, 30 multiple to our mind doesn't make any sense, because we all know that in FY26 that product is going to be completely commoditized, because the patent of the innovator is lapsing in that year. And right now the patent is valid and there is a settlement in place, which is why it's an interesting product for these generic companies. So that's the reason why unbranded generics fairly did well in the third quarter. But if you see what happened after the third quarter results was announced, the risk that I keep highlighting on unbranded generics, which is one, pricing risk, and two, regulatory risk. So you've seen, one of the larger companies getting an FDA import alert on their key plant for US FDA, for the US generic business. You've seen another very large company, which is unbranded mostly, get a very severe Form 483 on their plant. So that risk isn't slowing down. In fact, I was reading some reports that the US FDA have stationed some 25 FDA inspectors in India, and somebody who's very pro unbranded generic was interpreting it as that this tells you how important US believes India is for them, and they want to clear most of the facilities in India so that they can get more supply from India to the US market. I read it the other way. I say if they are posting more US FDA inspectors here, they don't want you to sell in US. See, let me give you an analogy. Neeraj, very interesting analogy. I think about 3 years back, India used to import 100% of our toy requirement from China, right? And then our government decided that they want to do make in India with China. You know how they did that? They did not impose anti-dumping duty on China or tariffs on China because WTO doesn't support that. They asked China to get BIS certification for their toys. So today we import only 40% of our toy requirement for China. 60% is actually in-house indigenous toys. I think that's what US is trying to do with US FDA. They can't put a tariff on us. So US FDA is a non-tariff barrier for pharma companies in India, and they are being actively discouraged to selling products in the US. Companies which had problems with US FDA in 2008, 2014 are still in problem. That's 10 to
Yeah.
15 years, right? And to my mind, that is a very clear indication of what the government or what the country or the regulatory body is thinking. And I don't see why we will turn positive on the unbranded side anytime soon, unless we see a dramatic rationalization in capacity of suppliers. So we
Yeah,
need
and
to
you're
see
not
many,
seeing
many
that.
pharma. Not at all, not yet. We are seeing more capacity being installed for the US business, especially by smaller pharma companies. The larger pharma companies have somewhat stopped putting more capacity because their current capacity is underutilized. But there are many, many small companies who are still announcing capex for the US market because they believe there is a product or two or a bunch of products where they can make a difference. They can earn a few $1 million. And therefore, the supply is still actually stagnant to going up. Yes, we are seeing some European capacities being shut. Yes, we are seeing some American capacities being shut. But these are small capacities. These are very, very small. If you look at the size of the capacity in Europe or America that is actually going out of the market, it is much smaller than the capacity expansion that we are seeing in India for the same market. So at a net level, we are actually still seeing capacity expansion for the US market. And that keeps worrying me because it's a commodity market. So unless your capacity falls short of demand, you will not see price inflation. See, what is everybody saying? Even in the concalls of the third quarter, what did the unbranded companies say? They said price erosion is moderating, which means the price which used to fall by 10 to 12% is now falling by 4 to 5%, but is still falling.
Falling.
How will margin improvement come with the price fall? It can't. So that's the reason why we don't favor unbranded generics. We keep a watch out for it. It's a very large bucket, and it can be really really interesting. If there is a situation where price inflation comes into play, as we have seen over injectables for the past decade. In the US, injectables prices were inflating, and you see the products of that price inflation in some of the injectable market cap that you see in the current market. That those market caps are unbelievable because those companies over the past 10 years have made tons of money by just increasing prices of generic products. But we don't see that happening as of now in the other product categories, and therefore we are staying away. On the branded generic side, we like the space. There is no capacity required, so there is very little capex. There is an opex element. Obviously, you need to hire more MRs and promote your brand. So it's more like an FMCG business, less like a pharma business. And we see that these companies have taken price increases. Obviously, raw material cost went up more than the price increase that these guys took. So they still had a margin impact, but that margin impact was to an extent limited because they were able to take some price increase. Come April 23, they will take another round of price increase. So in April 22, the price increase of 10.77% came from the average WPI from Jan to December of 2021. That was the average WPI, 10.77%, which is what was given to pharma companies in April of 22. So come April 23, you will get the average WPI of Jan to December 22, which number stands close to 12.5%. So you'll get another round of price increases in April 23, and hopefully raw material prices will which have already corrected. The inventory will come down, and you will have that double impact, right? You'll have lower cost and higher price. And that is why we are saying that top line growth might be 11-12%, but your bottom line growth can be 30-35%.
Okay, lovely. And I remember we've spoken about this in the past as well, Aditya. So thanks for highlighting it closer to time as well. So, well, so that's on one bucket, viewers, and I hope some of you got the idea as well. US FDA inspections, something that we've spoken about a number of times. That during COVID, the activity was lower for a reason. People were not here. Now that all of that is behind, it is clearly heightened inspections that are happening, and we're seeing that happening with multiple companies, including a large pharma company just a day or 2 days ago. Um, let's move tracks, Aditya, if you will. And before I move on to diagnostics, hospitals, and some others, I want to bring in API CDMO, a space which had a lot of promise and a space which is kind of disappointed massively in the last 3 to 6 to 9 odd months. And there was heightened investor interest there, and which is why the disappointment out there is magnified. Now, please tell us, how have you seen the last 9 months wherein companies have cited some developments not quite able to meet, and it moves from Divi's to Laurus to whoever else? And within that disappointment, there is this slight excitement or slight green shoot of CDMO as a pocket doing well. Now, how do you look at this overall picture?
Yeah, so it's a very, very interesting space today to discuss because this, as you said, it over the past 6 months, it disappointed many, many investors who were fairly bullish on the space, over the past 6 months. So were we. But I think it is the stock picking in the space which needed to be correct. So if you sort of take the examples of the two companies that you mentioned, the problem that both those companies have is same. So first problem that both those companies have is they are both very large suppliers and manufacturers of COVID-related products. So Divi's did it last year, Laurus is doing it this year. And therefore, both these revenue streams can't be sustained because these are COVID-related products, and hopefully the world is beyond COVID now. So,
Yeah.
if that is the case, then the supplies which they are making, which Divi's made last year and Laurus is making this year, it is not going to recur. So Divi's this year is reporting YOY decline in custom synthesis business, and Laurus next year will report YOY decline in their custom synthesis business because they will not be able to sell. And because these are patented products which they sold, they made high amount of money and high amount of margin, right? Now, the fear that investors have for Lotus is what the is currently happening with DVs. That you report YOY decline and suddenly your stock sort of takes a hitting because people feel what happened to the growth that we were promised in the space, right? So it's kind of being a victim of your own success. See, being getting a reward for a COVID-related product in India, being a DVs or a Lotus was actually a big victory for them. But it's a one-time cash flow, and the street, is not used to understanding probably how to value these cash flows. It's a one-time cash flow, value it at one time. Revlimid is a 4-year cash flow, value it at 4 times. Period. This is a simple math through it. But I think majority of the street still believes pharma or healthcare needs to be valued at a consolidated EV, EBITDA, or a PE multiple, and I think that's where they go wrong because some of these cash flows are just not 20-25 year cash flows. You just have to live with that. So I think the disappointment that came in these two large spaces, right, Lotus and DVs, because they had this COVID-related thing, and the other
Yeah.
thing which went wrong with them was on their generic side. So I've been saying that unbranded generic players are not making money. The biggest evidence of that is that their suppliers are not making money. So DV's had a severe, impact on their generic API supplies. Laurus had a serious impact on their generic API supplies and the margin. So revenue obviously flattened to decline. The margin actually took a bigger hit because the pricing went down and the volume probably kept where it was. So the operating deleverage basically took place. So I think you have to be very careful with your stock selection in the API CDMO space. This is not to say that the future of Loros and DVs is bad. No, it's not. It's just this YOY dip, which is sort of creating this panic and this situation in the custom synthesis business and the generic business. I think the baseline is now where it is. I don't feel that they will get worse, but they may get worse because it's unbranded. You can't really call that out with much confidence. So the way we did it was we focused more on stocks like Newland or Heikel, where in fact custom synthesis is a larger part of the entire profit pool than the generic part is, and that is how you should have played that. So even going forward, we are going to be more focused on those companies where custom synthesis becomes a bigger part of their cash flow and their valuation rather than generic business, because we just know that generic business it's very hard to call. We don't know what the future is, but we know the future is very, very hard to call. So we are very clear that the API CDMO space has a very long runway for growth. There is enormous amount of capacity being created in India, and customers from China, customers who are buying from China want to buy from India, want to do this from China, and but that will take its own time. It's a regulatory business. There will be regulatory processes involved. But the runway for growth is extremely long. So I am absolutely confident about the space, but you need to be in the right stocks.
Okay, and you reckon, Aditya, that that's the pocket that might last for the near term, at least the test of time, because uh, there are issues, as you said, on a YOY basis for the COVID-related business for DVs or Loris or for some of the others, vis-a-vis some other or other companies out here who are in the custom synthesis, and therefore the lack of growth or maybe the growth prospects are a lot stronger, even in FY24 and the slightly near term.
That's true. And also remember, API companies are also conglomerates. So they have this generic business, they have this custom synthesis, they will have a bio research business, they will have some formulation business. So we avoid companies which are purely or largely generic. And we try to bet on those which are largely custom synthesis because there the business is just flowing. Best proxy for that to understand what is happening there is maybe tracking a company called Wuxi Aptech in China. So Wuxi Aptech in China is the largest contract manufacturer custom synthesis business in China. And if you see their top line growth is 35 to 37% CAGR, and they're pretty much projecting the same top line growth to continue. And this is despite China plus one. So the players in our country who can present an alternative to such a player in China are the ones who, for the next 10 years, will continuously surprise us on the upside.
Very interesting. Thanks for that, Aditya. That's a little nugget, all right. Um, Again, changing tracks now, and different businesses, hospitals and diagnostics, but I'm starting off with them now. Hospitals, much as people believe that they haven't, but they have created wealth the last 3 4 5 years, a bunch of hospital stocks. The leader has certainly done well, a couple of others too kind of there, not there. Now tell us, to your mind, is the is are we at peaks when it comes to, operational metrics, return metrics, or is there further room for improvement? That is part one of my question. And part two, therefore, with the capacities being the way they are, and the hospitals themselves adding a few other levers to their main business, ancillaries to their main business, how do they look as investment bets for the next 2, 3, 5 years?
Sure. So, let me give you an example. I think best way to understand this is understand by example. So, there's a super specialty oncology hospital company, and I was on their con call and in the third quarter, and they reported about 18-19% EBITDA margin in the third quarter, which is higher than the margins that they've been reporting in the past. And I asked them the question that what is your highest margin center, which is always probably the most oldest center, the center which the hospital chain might have started with. In this case, it was a Bangalore center. So I asked them, what margins do you make in your Bangalore center? The response was 28% EBITDA. And they report as a company 18 to 19% EBITDA currently per quarter. So I told them that, so at a consolidated level, maybe not every hospital reached that 28% EBITDA, because that 28% is your first hospital, the flagship hospital, much better technology, much more brand equity than the others. But as a consolidated entity, what do you think your peak EBITDA can be? They said 25%, right? And they're currently at 18-19%. So I think, and their ROE currently is barely like a percentage or two compared to other hospitals that are doing 18-20% ROE, because this company just has a lot of depreciation into it. So ROE as a metric in hospital gets slightly tricky, because a lot of depreciation sits there, a non-cash expense. So maybe ROE is not the best number to look at, but maybe cash flow yield or free cash flow yield or operating cash flow yield. So wherever there are businesses with a very high depreciation, ROE and ROIC becomes slightly tricky, because both these numbers comes after depreciation. So it's better to take metrics which are more cash flow oriented, which are your operating cash flow yield or free cash flow yield. So this company on an operating cash flow yield is far superior to the other listed hospitals. But on a ROE basis, it is just a 2% ROE business if you look at it, compared to maybe a 14% ROE or a 15% ROE of some of the other listed hospitals. So clearly, within hospitals, you can't really make a statement that all hospitals have matured and all are at peak margins. But yes, some of the hospitals which are, I think, very old chains are closer to their peak margins, are closer to their peak ROEs. From here, I think incremental ROE, incremental margin will be a tough ask. Obviously, digitization, case mix improvement, price increases, improvement in ARPOB, all that reduction in ALOS, average length of stay, all this will help them to improve margins somewhat. But a meaningful uptick in margin from here is something I don't see in some of the very mature chains. But in some of the very younger chains, there's a lot of scope for growth. There's a lot of scope for improvement. And as I said, the stock prices aren't really giving me the sense that the street is expecting any material improvement. So when that improvement comes, then you will see some of the younger chains surprise you on the positive side, and some of the older chains may continue to compound, but may not give you outsized returns. You also have to
Okay.
understand. You also have to understand, Neeraj, that our hospital ecosystem is only about 40-50 years old. In healthcare, 40-50 years is a very small period of time. We haven't seen the sector mature. The sector is still at a very nascent stage. So it is perfectly possible that I'm wrong. It is perfectly possible that the mature hospitals which are currently doing 15, 16, 17% ROE can actually over time grow to 25-30% ROE. And at that time, if you ask me this question again, that Aditya, where do you see, are we at peak ROE? I'll tell you probably that in mature hospitals are at peak ROE 25-30%, but the younger ones would be at 15-20%. So they will go to 25-30%. So I'm biased by my position. I understand that. But at the same time, I'm telling you that global hospitals don't do more than 20% ROE. So, if that is going to be the norm, then, the more mature hospitals in India are closer to the peak, and the younger ones are far away from the peak.
So, on a relative basis, the younger ones might give you a bigger bang for the buck, but it's okay for a company or a business to not expand ROE necessarily, but maintain ROE, maintain margins, show growth, and still have both revenue and earnings growth potential, and maybe multiple expansion. Could that happen?
See, that could happen in terms of, so if you grow earnings, if you grow revenue, but not grow margin or ROE, generally multiple expansion doesn't happen.
Won't happen.
Unless your revenue and bottom line growth is outsized, unless it's like 20-25% bottom line growth and 15-20% top line growth. If it's broadly in line with the healthcare market, which is 10-12% top line growth, 15-18% bottom line growth, I don't see much expansion scope in terms of the multiples. Uh, the other thing which you spoke of was very interesting. It was the diversification being done by these larger chains in hunt of more engines for growth, right? So some large hospital chain is trying to create an online platform, a 24/7 platform on which they want to sell medicines online, they want to do diagnostics online. They're burning cash today on that platform, but they're saying that losses will minimize and they will turn profitable someday, and so on and so forth. That's a great thing to do. The only problem is it's ROE dilutive. So we haven't had a case study, because, and this is why I say it's a young sector. We don't have a case study where this online discounted platform has actually made money. We have no examples whatsoever. So because we don't have an example, I don't know what to expect of it, right? I don't know what to make of it, and I don't know whether they will reach the cost of capital, which is, let's say, 15%. Will they reach that 15% cost of capital ROE over the next 5 years, 10 years, 20 years? It's very unpredictable for us. It's new, right? Now, my trouble today as an investor is that because it's new, because it's unpredictable, and yet the stock or the company is getting all the benefit of doubt, it is maybe not a good risk reward trade for me. Because then if they miss, because it's unpredictable, they can miss. And if they do, then the outcome for shareholders is not going to be a very pleasant outcome.
Got it. Well, Aditya, my final question, and that's on, or final set of questions, and that's on diagnostics. And now, um, you are an informed watcher of the space. I'm an observant of the space, and we've been at loggerheads about what kind of impact does this whole online plethora of online businesses do to diagnostics, do they disrupt, etc. Uh, and I know you've told me in the past that the prices went up because of that one-time COVID impact, and people extrapolated it. Now it's normalcy. My question to you is, from where we are right now, how constructive are you? Because let me tell you, I mean, you have been constructive. It's but the prices really haven't moved too much. You have to
They
admit. So,
haven't.
what is your stance on diagnostics currently, and why so?
Yeah. So the first admittance is that not only have the prices not moved too much, the prices have actually materially declined from when we last spoke. So far, you have been correct and I have been wrong.
No,
That's
no.
so call
I'm
an
just
ace an ace.
questioning, nothing else.
Absolutely. Yeah. So we'll call a spade a spade. So far we have been proven wrong by the street, but we have not been proven wrong by the companies. So if you look at the data that Thyrocare reported, let's say for instance in third quarter, Thyrocare ex-COVID top line in the third quarter grew 22% year over year. So COVID revenues were down 98% year over year, but we all knew that was going to happen, right? If you look at, let's say, Krishna Diagnostics, their top line grew 12-13% year over year. This is again ex-COVID. Yes, Metropolis and so Metropolis also reported double-digit growth. I think Dr. Lal was probably the only one that reported single-digit growth in top line. And I have been saying time and again, Dr. Lal, because of their challenge in northern India, where they've become just too large to grow ahead of the market. I think that's the reason, and the suburban acquisition, which maybe is slightly tricky for them to digest, doesn't seem like a very good acquisition. So Dr. Lal has its own specific nuances, but other than them, the other three, four chains that are listed all reported double-digit growth in top line. So why have these stock prices declined? There can be multiple reasons. To my mind, I think these are small and mid cap stocks, and I think the overall market situation today is such that small and mid caps, anything which is failing to sort of excite investors is just declining, and that's across sectors, across straight off equities. So diagnostics being one such space, I think each and every stock in diagnostic is down, and that is not something which is company specific or sector specific. It's something which is investor sentiment driven. Uh, but the numbers, if they continue to report double-digit top line and more than double-digit in terms of bottom line growth, as in with operating leverage over bottom line growth, this trend probably may not sustain, because remember, every time the stock price declines and the profit grows, the stock becomes cheaper and cheaper,
Yeah.
and the cash flow yield and the dividend yield and all those things then start coming into play. So I think we are very very close to the bottom maybe of diagnostic valuations. I haven't seen diagnostic valuations this cheap ever in India since they start IPO'd back in 2016-17. I think Dr. Lal was the first IPO. I think since then we haven't seen these kind of valuations, and this is the cheapest valuation these stocks have traded at. And that gives me a lot of comfort because the top line growth is still there. So there's no disruption. Even today, there was an article in a newspaper which said that online players have already increased prices from 150 to 300, 400, and now the brick and mortar players are also going to increase prices because if the competition is increasing prices, why should we not? So there is a lot of comfort. So I don't see necessarily a thesis being broken. Has it performed well yet? No, but can it? Yes, because the data points are still supporting the thesis.
Good. Just one quick follow up before we wrap up this conversation. Could there be a slightly prolonged period of price underperformance simply because YOY, maybe for a quarter or two, there might still be these COVID related business loss, which might impact the overall top line of these players?
So yeah, I think fourth quarter is the last quarter where you have any
Fourth
COVID
quarter, the
sales in the
last quarter.
base.
Okay.
Yeah, where you have any COVID sales in the base because last year same quarter we had some Omicron related
Yes.
COVID sales. After that, there is no more quarter left for COVID sales. So you're looking maybe a 3 to 6 month period at best.
Got it. Aditya, lovely talking to you as always. Thank you so much for taking the time out and giving us a lowdown on that entire space. 37 minutes that we've spoken to you, but it was lovely. Thank you for taking the time out.
Thanks, Neeraj. Thanks for having me. Always a pleasure.
The pleasure is ours. Viewers, thanks for tuning into this leg of the Talking Point.